When financial markets shift from one extreme, they frequently move in the opposite direction with equal intensity during the transition to a new norm. I believe that's the situation silver faces currently, so those individuals continuously advising, exit your position, secure gains, prices will retreat to 50. It must return to these previous peaks here or there or similar. And then you realize, like perhaps a week or two back, silver fell 15% within roughly 2.5 days, and several days following, you've returned to peak levels. What's their reasoning? Can't they recognize that this isn't a typical upward movement? You no longer see these extended multi-month pullbacks anymore. Now, they're calculated in days, and honestly, we anticipate silver to achieve, my floor is around 200, but I wouldn't be surprised if it nears 500, to be honest. And there are certain additional elements at work regarding that too that we could discuss if you're interested. Silver has stopped acting like a traditional bull market, and that's precisely the indicator numerous traders are missing. When financial systems correct from one extreme, they frequently overshoot toward the other side, and silver currently seems to be entering that rapid growth stage. Recent price drops have been severe, yet brief-lasting, spanning days instead of months, and have bounced back swiftly. This type of market action indicates that fundamental demand is overpowering attempts to contain the market, suggesting a fundamental transformation rather than a fleeting surge. Michael Oliver, an experienced momentum and chart analyst, has stressed that this movement doesn't mirror a standard rally. In his assessment, anticipating silver to merely return to previous peaks fails to grasp how momentum-fueled patterns truly develop. Oliver has specified a baseline objective around $200 while simultaneously acknowledging frankly that a climb approaching $500 wouldn't be shocking if existing forces continue and banking system pressures keep mounting. With that framework established, we now transition to segments from Michael Oliver's discussion. What's happening in silver currently is not typical, and don't anticipate it to be typical. Most chart analysts, when they examine any particular market, they look backward through the previous couple years in that asset, and they observe patterns like, extreme overbought, oversold, momentum targets, things like that. And they're still operating in that mindset with silver, and I believe they're making a significant error. Silver is currency. Remember, don't overlook its currency. It's not merely silver is like riding on a surge, but it's actually on dual surges. The one that's the major one is the monetary component of silver and gold. That's the primary distinguishing asset quality underlying those metals. But silver additionally has the commercial component, which is surging because, we understand demand for silver in several high-tech sectors and all the information centers and computing and photovoltaic panels and et cetera and et cetera. It's in demand that is exceeding supply and has been for 5 years currently, and it keeps growing, meaning the shortage grows. So it's got a genuine challenge in that respect. So that's the additional surge that most individuals are concentrated on, that, the silver demand due to this, that, and the other. They're overlooking its currency, and it's extremely underpriced to its parent metal gold throughout history. And this is one of the catalyst points that prompted silver to do what it just accomplished in the previous 8 weeks. I'll clarify it for you. Silver ebbs and flows relative to gold. It rises in value, falls in value, and you can chart it on a graph, and we do it slightly differently. We don't do the ratio, we do it. We divide an ounce of silver into an ounce of gold, and we calculate a percent. And if you go backward over 50 years, like to 75, and chart what was the strongest reading that silver achieved that year monthly, close relative to gold, what was the peak comparative performance reading, and we chart it, okay? Well, back in the 79 to 80 bull rally in silver, which was still inside that span, the half-century span of $4 to 50, $4 to 50, that spike in 79 and 80, which in the final 5 months of that continuing bull rally, already for silver and gold, silver climbed up 4.5-fold in 5 months, hitting $50 for the initial time, 1980, okay? What triggered that previously existing bull trend in silver to go wild on the upside and do it bam like that completely transformed the nature of the reality that was under expected, okay? And then in 2010 and 11, silver had previously been climbing for years once more alongside gold, but, tiered type go, rally, frustrating for the bulls, but still upward, upward, upward. And then abruptly in September of 2010 through April of 2011, so it's 6-7 months, silver doubled in a half in value. September 2010, it was like in the 20s, suddenly climbed to 50 once more, and it accomplished it for years of rally. Suddenly, in the final couple quarters, it went wild again, halting at the peak of the old, what is now a 50-year span, was a 50-year span. What triggered that explosion? Why didn't it simply climb to those peaks in the identical manner that had been climbing already? Why did it go wild? When you chart the differential of silver relative to gold during those periods, you'll observe that there was like a cap. I'm speaking technically now on that differential chart. Every month, you chart the difference B. And there was like a shallow cap that existed during that bull rally of silver and gold, where silver just couldn't rise above a particular level in relation to gold, and abruptly it burst above it. And that would have been in like the summer of 2000, 1979. And when it did, that's when the value of silver went berserk, quadrupled in a half in 5 months, and then in 2010, it was September of 2010, previously climbing in value, silver was in the 20s. And that differential also broke above a cap that any novice drawn a chart could observe if you chart the differential chart the way we do. And boom, in 7 months, it doubled in half. Same thing occurred this time, except even more obvious on the differential chart. Even a broader base covering 10 years of cap of silver to gold. Silver to gold. Couldn't rise above that ratio, that percent. And the November close broke above it. Bam. Suddenly silver goes wild. That period of time we discover in numerous other markets in those uncommon periods when a market has been trapped in a span for multiple years, decades. Copper accomplished this, for instance. It had been in a span from 50 cents to $1, $50 in the 1970s, 1980s, 1990s into the year 2005. And in the latter section of 2005, it broke above that span, and in a matter of a couple quarters climbed to $4, $50. 50's $1.50 to $4.50 on its own. It wasn't linked with, for instance, other base metals. It accomplished it on its own. Wasn't even linked with what gold and silver were doing then. A year and a half following did the same thing. You could chart a lead graph going backward multiple decades, and it was in its old reality. And when it broke through that in a several quarters, boom, it quadrupled in half in value, all compressed inside a couple quarters once more on its own. Wasn't linked with the copper movement even. So we've observed these events happen in other markets, where an old value reality which has existed so long you can't fathom it. You're bored by it. You believe it's the genuine reality to exist forever. It doesn't. And when the market transitions into a new reality, sometimes it accomplishes it in an exaggerated fashion, in a rapid fashion. We understand this in other markets, like, we observe bubble peaks in the equity market, and we've numerous individuals look backward on them and say, gee, I should have recognized that. And sure enough, the crash that followed was quite dramatic. .com peaked to the dot, the 2002 low. NASDAQ 100 fell 82% in 2 years, completely erasing the entire dot bubble. Okay, 2007-2009 similar type sequence. But the point is that when a market has done something in error, either extreme on the upside or extreme on the downside, in this situation for silver, trapped in a 50-year span when you can examine every other market in the world, copper, lead, gold, they weren't trapped in that 50-year span. Hit the subscribe button and stay updated.